And Namaskar. Welcome to this Think and Link series. I'm your host, Srinivasan. Today, I would like to cover a very interesting topic, a topic of a relationship between dividend payout and capex. A recent study by the Economic Times on capex and dividend payout ratio makes a very interesting reading. The study concludes that India Incorporated have started opening up their kitties for capex. So let's see what this research tells us. So first, let us define what uh, a dividend payout is. So simply said, the dividend payout ratio is the proportion of company's earnings paid to the shareholder as dividends. So for example, if a company is earning, say, 100 rupees and it earmarks 30% or it pays 30% of it, that is 30 rupees, by the way of dividend to the shareholders, then you can say that the dividend payout ratio is 30%. Let's also define what is buyback, because that is also going to be important when we are going to study this report of Economic Times. A buyback is a company's purchase of its own shares from the stock market, right? So, what is the advantage of buying back? That is the question that people may frequently ask. Now, a repurchase reduces the number of shares outstanding, and thereby it inflates the earnings per share and often leading to further increases in stock market prices. That is what a buyback does. Now, if you view from a market point of view, a shareholder or an investor would always view a share repurchase as a positive sign. A positive sign that the business has got plenty of cash and that the business, instead of investing in the business itself, is willing to give it to the shareholder. Another reason why there could be a buyback is to prevent a major shareholder from taking controlling stake in the company. So, having defined what is dividend payout and what buyback is, let's see what the research paper says. It says that India Incorporated, that means now we are talking about the corporate sector in India. It says that it has been less generous with dividends in the FY24, that is the financial year 24, than in the previous 9 years. And this is due to an increase in capital expenditure, which came about because the average capacity utilization had increased. And not only increased, it had exceeded the long term average, and therefore the companies thought necessary to get into capital expenditure. Now, a quick look at the dividend payout ratio for FY22 was 37%, which increased to 43% in FY23. It increased to 34% in FY24. Now, if you were to include buybacks also, then the payout ratio changes. So the payout ratio for FY22 was 41%, and this changed to 44% in FY23. And it was 38% in FY24. So you will observe that this payout tends to be lower in times when the company spent more on expansion. So this is a good sign. Not only that, companies with high cash flow in mature industries tend to have a higher dividend payout ratios, as I told you earlier, because the company is of the opinion that the money in the hands of the shareholder makes more sense than the money they have, because they do not have a good profitable investment avenue. Now, according to the research paper, about 1,300 companies paid around 4.15 lakh crores in dividend in FY20 compared to their standalone profit of 12.24 lakh crores. Now, additionally, during this year, about 41 companies spent about 50,750 crores on share buyback in the same FY24. Now, these figures for FY23 was much more. It was 4.4 lakh crores by the way of dividend distribution. And the money spent on share buybacks was hardly about 21,500, which is almost half than a little less than half what it was during the previous year. Now, investment in several projects have been gaining momentum with companies allocating more and more funds towards expansion. Now, if you see how the dividend distribution was amongst the top 15 industry houses, that also makes a pretty interesting reading. The top 15 industry houses in India paid on an average 43% of their profits as dividend in FY24. Now, this was significantly lower than 75% and 44% paid during the prior two fiscal years. So, definitely the dividend has been slashed down considerably. Now, when you talk about the Tata Group, which actually led this list of dividend payments of 32,000 crores, this was again 38% less than the previous year. If you're talking about HCL Group, that is Shiv Nada's HCL Group, it paid about 14,120 crores in FY24, and which is much, much higher than 13,035 crores in FY23. If you come to Vedanta Group paid around 11,000 crores in FY24, marking an increase of 84% over the previous year's dividends, which was about 69,000 or almost say 70,000 crores. So it was a decrease. The payout ratio for Mahindra and Bajaj Group also dropped marginally for FY24. On the other hand, of course, there were few groups like Bharati Group, Aditya Birla Group, and Sun Group, Sun Pharma Group, and Hinduja Group, and Torrent Group, which rose substantially. The impact of this roaring growth of stock market in FY24 meant enormous increase in wealth, and this in turn led to higher dividend payout. So many promoters allocated more funds for capital expenditure instead of giving out dividends. Additionally, some large companies in mature industries rewarded shareholders through buybacks instead of dividends. And there is another interesting aspect which was observed by India Ratings and Research Private Limited. They said that private investment proposals sanctioned by the bank rose by nearly 1 lakh crores to 3 lakh crores in FY24. So clearly, the drawdown of surplus indicates that recovery in private investments has already taken place. So this bodes well for growth and output and employment. And that is all from me today. See you in another episode later. Bye bye. Take care.